Question 1. Regulatory review indicates that a Registered Futures Commission merchant, FCM, in Chicago, Illinois, has recently terminated the employment of an associated person, app. To ensure compliance with NFA registration requirements, which of the following actions should the FCM's compliance department take as the absolute priority? Option A. Assume that the associated person's resignation from the firm automatically terminates their NFA registration. Option B. Immediately submit the required AP termination notice to the NFA through its online registration system. Option C. Wait for the associated person to formally request that their termination notice be filed with the NFA. Option D. Submit the AP termination notice only after the associated person has secured employment with another NFA member firm. Correct answer is B. Immediately submit the required AP termination notice to the NFA through its online registration system. Explanation. Scenario analysis. This scenario presents a common challenge for compliance professionals in the futures industry, specifically concerning the registration and termination of associated persons, app, with the National Futures Association, NFA, in the United States. The core difficulty lies in ensuring timely and accurate compliance with NFA Bylaw 1101 and related rules, particularly when an AP's employment is in flux. Failure to adhere to these requirements can lead to regulatory sanctions, reputational damage, and operational disruptions. The need for meticulous record-keeping and proactive communication between the firm, the app, and the NFA is paramount. Correct approach analysis. The best professional practice involves immediately initiating the AP termination process upon the AP's departure from the firm. This includes promptly submitting the required AP termination notice to the NFA, typically through the NFA's online registration system, e.g., XM. This action formally severs the AP's association with the firm in the NFA's records and stops any further registration-related obligations for the firm concerning that individual. This approach directly addresses the regulatory requirement to notify the NFA of an AP's termination within a specified timeframe, preventing potential liabilities for the firm and ensuring the AP is no longer considered registered under the firm's sponsorship. Incorrect approaches analysis. One incorrect approach involves waiting for the AP to formally request their termination notice be filed. This is a significant regulatory failure because the responsibility for notifying the NFA of an AP's termination rests with the sponsoring firm, not the AP. Delaying this process can result in the firm being held responsible for the AP's actions after their departure, as the NFA's records would still indicate an active association. Another incorrect approach is to assume that the AP's resignation from the firm automatically terminates their NFA registration. NFA registration is a formal process that requires specific notification from the sponsoring firm. Simply leaving the firm does not trigger the termination of registration in the NFA system. This oversight can lead to the AP remaining erroneously registered under the firm's sponsorship, creating compliance risks for both parties. A further incorrect approach is to only submit the termination notice after the AP has secured employment with another NFA member firm. The NFA Bylaw 1101 requires prompt notification of termination, irrespective of the AP's future employment status. Delaying the notice until the AP is responsored is not compliant and can create a period where the AP is no longer associated with the firm, but still appears as such in NFA records, or vice versa, leading to potential confusion and regulatory issues. Professional reasoning. Professionals in this role must prioritize a proactive and diligent approach to NFA registration matters. The decision-making process should be guided by a thorough understanding of NFA Bylaw 1101 and the firm's internal policies regarding AP terminations. When an AP's employment ends, the immediate action should be to consult the NFA's registration requirements and initiate the termination process without delay. This involves verifying the AP's departure, gathering necessary information for the termination notice, and submitting it through the designated NFA system within the stipulated timeframe. If there is any ambiguity or uncertainty, consulting with the firm's compliance department or legal counsel is essential to ensure adherence to all regulatory obligations. Question 2. Consider a scenario in Illinois where a client, who operates a large agricultural business, proposes to enter into a series of futures contracts on corn. The client states that these contracts are intended to hedge against potential price declines in their upcoming corn harvest. As the branch manager, what is the most appropriate course of action to ensure compliance with NFA regulations regarding bona fide hedging transactions? Option A. Approve the futures contracts immediately, as the client has explicitly stated they are for hedging purposes to mitigate price risk. Option B. Advise the client that hedging is primarily about risk reduction and ask them to confirm their understanding of this principle before proceeding. Option C. Engage in a detailed discussion with the client to understand their specific business exposures and the precise risks the futures contracts are intended to offset, and verify that the contracts are directly related to and proportionate to those risks. Option D. Approve the futures contracts if they are likely to generate profits, as this can indirectly offset other business risks the client may face. The correct answer is C. Engage in a detailed discussion with the client to understand their specific business exposures and the precise risks the futures contracts are intended to offset, and verify that the contracts are directly related to and proportionate to those risks. Explanation. Scenario analysis. This scenario presents a common challenge for a branch manager in Illinois, requiring a nuanced understanding of NFA regulations concerning bona fide hedging transactions. The core difficulty lies in distinguishing between a genuine hedging strategy designed to offset existing risks and a speculative position disguised as hedging to circumvent margin requirements or other regulatory oversight. Mischaracterizing a transaction can lead to significant regulatory penalties, reputational damage, and harm to clients. The branch manager must exercise careful judgment to ensure compliance and uphold ethical standards. Correct approach analysis. The best professional practice involves a thorough review of the client's overall trading strategy and the specific rationale for the proposed transaction. This approach requires the branch manager to engage in a detailed discussion with the client to understand the underlying business or market exposure the transaction is intended to hedge. Crucially, it necessitates verifying that the proposed futures or options contracts are directly related to and proportionate to the client's existing risk. This aligns with NFA Interpretive Notice 03-04, which emphasizes that a bona fide hedging transaction must be used to offset risks arising from actual business operations or positions, not for speculative purposes. The branch manager must document this understanding and the basis for classifying the transaction as hedging. Incorrect approach is analysis. One incorrect approach involves accepting the client's assertion that a transaction is for hedging purposes without independent verification or due diligence. This failure to investigate the true intent and nature of the transaction violates the branch manager's responsibility to ensure compliance with NFA rules. It opens the door to speculative positions being misclassified, potentially leading to inadequate margin and increased risk for the client and the firm. Another incorrect approach is to approve the transaction solely based on the client's stated intention to reduce risk, without assessing whether the proposed futures or options contracts are reasonably related to the client's actual underlying exposure. This can result in a transaction that, while perhaps intended to mitigate some risk, is disproportionate or unrelated to the actual business risk, thus not meeting the definition of a bona fide hedge under NFA guidelines. A further incorrect approach is to approve the transaction based on its potential to generate profits, even if the client claims it's for hedging. This fundamentally misunderstands the purpose of hedging, which is risk mitigation, not profit generation. Approving a transaction based on profit potential, regardless of its hedging efficacy, indicates a disregard for regulatory definitions and ethical obligations. Professional reasoning. Professionals in this role should adopt a proactive and inquisitive stance. When presented with a transaction that is claimed to be a bona fide hedge, the decision-making process should involve 1. Understanding the client's business and existing exposures. 2. Clearly defining the specific risks the proposed transaction aims to offset. 3. Verifying that the proposed futures or options contracts are directly linked to and proportionate to those identified risks. 4. Documenting the rationale and the basis for classifying the transaction as a bona fide hedge. 5. Consulting with compliance or legal counsel if there is any ambiguity or doubt. This systematic approach ensures adherence to regulatory requirements and upholds the integrity of the firm and its client relationships. Question 3. Upon reviewing the operational status of a branch office in Illinois, The NFA branch manager is tasked with conducting an on-site audit as required by NFA Rule 2-9. Considering the need for thoroughness and compliance, which of the following actions best fulfills this responsibility? Option A. Conduct a systematic review of the branch's books and records, including customer account statements, trade blotters, and compliance logs, documenting all findings and any identified discrepancies or potential rule violations. Option B. Engage in a general conversation with the branch staff about their day-to-day activities and any challenges they are facing, without a specific focus on compliance documentation. Option C. Rely on the branch manager's informal observations and the staff's verbal assurances that all procedures are being followed correctly. Option D. Delegate the entire audit process to the most experienced registered representative in the branch, trusting their judgment to identify any significant issues. Correct answer is A. Conduct a systematic review of the branch's books and records, including customer account statements, trade blotters, and compliance logs, documenting all findings and any identified discrepancies or potential rule violations. Explanation. This scenario presents a common challenge for NFA branch managers, balancing the need for thorough, independent oversight with the practical realities of managing a branch office and maintaining positive working relationships. The core professional challenge lies in ensuring compliance with NFA Rule 2-9 branch office audits and related regulations while avoiding undue disruption or creating an atmosphere of distrust. The manager must demonstrate due diligence in their audit process without appearing overly intrusive or accusatory, which could negatively impact morale and productivity. The best approach involves a structured, documented, and objective review of branch operations, focusing on identifying potential risks and ensuring adherence to NFA rules and firm policies. This includes a systematic examination of records, procedures, and controls, with a clear plan for addressing any identified deficiencies. This method is correct because it directly aligns with the NFA's expectation of robust internal controls and regular oversight, as mandated by Rule 2-9. It provides a defensible record of the manager's commitment to compliance and risk mitigation, protecting both the firm and the branch staff. The process is designed to be proactive, identifying issues before they escalate into significant compliance breaches. An approach that involves a casual, informal chat with the branch staff about their daily activities, without any specific focus on compliance areas or record keeping, is insufficient. This fails to meet the NFA's requirement for a systematic audit designed to detect violations. It lacks the necessary documentation and objective assessment to demonstrate due diligence. Another incorrect approach would be to solely rely on the branch manager's self-assessment or to delegate the audit entirely to a junior staff member without proper supervision or a defined audit plan. This abdication of responsibility and lack of independent verification undermines the integrity of the audit process and is unlikely to uncover potential compliance issues. It also fails to meet the NFA's expectation that the branch manager is ultimately accountable for the branch's compliance. Finally, an approach that focuses exclusively on identifying minor procedural errors without considering the broader compliance framework or potential systemic risks would be incomplete. While attention to detail is important, a truly effective audit must assess the overall effectiveness of controls and adherence to all relevant NFA rules and firm policies. Professionals should employ a decision-making framework that prioritizes a risk-based approach to audits. This involves understanding the specific risks associated with the branch's activities, developing a clear audit plan that addresses those risks, conducting the audit objectively and systematically, documenting all findings thoroughly, and implementing corrective actions promptly. This framework ensures that audits are not merely a procedural exercise, but a vital tool for maintaining compliance and protecting the firm. Question: upon reviewing the operational status of a branch office in Illinois, the NFA branch manager is tasked with conducting an on-site audit as required by NFA Rule 2-9. Considering the need for thoroughness and compliance, which of the following actions best fulfills this responsibility? Options: A. Conduct a systematic review of the branch's books and records, including customer account statements, trade blotters, and compliance logs, documenting all findings and any identified discrepancies or potential rule violations. B. Engage in a general conversation with the branch staff about their day-to-day activities and any challenges they are facing, without a specific focus on compliance documentation. C. Rely on the branch manager's informal observations and the staff's verbal assurances that all procedures are being followed correctly. D. Delegate the entire audit process to the most experienced registered representative in the branch, trusting their judgment to identify any significant issues. Question 4. When evaluating the retention policies for electronic trading records at a U.S.-based futures commission merchant, what is the most compliant and professionally sound approach to ensure adherence to CFTC and NFA regulations? Option A. Delete electronic trading records after 1 year, assuming that older data is unlikely to be relevant for future regulatory inquiries. Option B. Convert all electronic trading records into a compressed, proprietary database format that requires specialized software for access to optimize storage efficiency. Option C. Retain all electronic trading records, including order tickets and blotters, in their original electronic format for the full regulatory retention period, ensuring they are readily accessible for examination. Option D. Retain only summary reports of trading activity, discarding the original detailed electronic order tickets and blotters after a brief internal review. The correct answer is C. Retain all electronic trading records, including order tickets and blotters, in their original electronic format for the full regulatory retention period, ensuring they are readily accessible for examination. Explanation. When evaluating the retention of electronic trading records for a futures commission merchant, FCM, operating in the United States, a branch manager faces a professionally challenging situation. The challenge lies in balancing the operational efficiency of record management with the stringent regulatory requirements mandated by the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA. Misinterpreting or neglecting these requirements can lead to significant compliance violations, fines, and reputational damage. Careful judgment is required to ensure all records are preserved in a manner that is readily accessible for examination and audit. The best professional practice involves implementing a system that ensures all electronic trading records, including order tickets, trade confirmations, and blotters, are retained in their original electronic format. This approach guarantees the integrity and authenticity of the records, which is paramount for regulatory compliance. Specifically, CFTC Rule 131 and NFA Rule 2-10 mandate that FCMs retain records in their original format for a specified period, typically 5 years, with the first 2 years readily accessible. This method directly addresses the regulatory intent of preserving records in a way that allows for accurate reconstruction of trading activity and facilitates efficient oversight by regulators. An incorrect approach would be to convert all electronic trading records into a compressed, proprietary database format that requires specialized software to access. While this might save storage space, it creates a significant barrier to regulatory examination. Regulators may not have access to the proprietary software, rendering the records effectively inaccessible and in violation of the readily accessible requirement. Furthermore, the conversion process itself could potentially alter the original data, compromising its integrity. Another professionally unacceptable approach is to retain only summary reports of trading activity, discarding the detailed electronic order tickets and blotters. This fails to meet the requirement of retaining records in their original format and deprives regulators of the granular detail necessary to conduct thorough investigations into trading practices. Potential market manipulation, or customer disputes. Summary reports lack the essential audit trail provided by the original electronic records. Finally, adopting a policy of deleting electronic trading records after a shorter period than legally required, such as 1 year, based on the assumption that older data is unlikely to be relevant, is a clear violation. This disregards the explicit retention periods set forth by the CFTC and NFA, which are designed to cover a comprehensive historical view of trading activities for regulatory purposes. Professionals should employ a decision-making framework that prioritizes understanding and adhering to the specific record-keeping rules of the CFTC and NFA. This involves regularly reviewing regulatory updates, consulting with compliance departments, and establishing robust internal controls and procedures for record creation, retention, and retrieval. The framework should emphasize the preservation of data integrity and accessibility for regulatory purposes above operational convenience. Question 5. The analysis reveals that a branch manager in Illinois is reviewing the firm's procedures for handling customer orders. The manager needs to ensure that the firm is compliant with NFA regulations concerning the preparation and retention of order tickets. Which of the following approaches best reflects the required regulatory standards for order ticket management? Option A. Store all order tickets in a physical location with a general filing system, without a specific retention policy or retrieval protocol. Option B. Rely on the trading desk to identify and correct any discrepancies on order tickets after the trades have been executed. Option C. Retain only those order tickets that correspond to trades that resulted in a profit for the customer. Option D. Implement a mandatory pre-transmission review of all order tickets by a registered associate to verify completeness and accuracy, and maintain a systematic, easily retrievable record of all order tickets for the required retention period. The correct answer is D. Implement a mandatory pre-transmission review of all order tickets by a registered associate to verify completeness and accuracy, and maintain a systematic, easily retrievable record of all order tickets for the required retention period. Explanation. The analysis reveals a common challenge faced by branch managers in ensuring compliance with NFA, National Futures Association, regulations regarding order ticket preparation and retention. The scenario is professionally challenging because it requires a proactive and meticulous approach to prevent potential regulatory violations that could lead to significant fines, reputational damage, and disciplinary action against the firm and individuals. The manager must balance operational efficiency with strict adherence to rules designed to protect customers and market integrity. The best professional practice involves a comprehensive review of all order tickets for completeness and accuracy before they are transmitted for execution, and establishing a robust system for their retention. This approach directly aligns with NFA Rule 2-10, which mandates that members and associates must keep and maintain records in a manner that is readily accessible and clearly shows the terms and conditions of each order. Specifically, it ensures that essential information such as customer name, account number, commodity or product, quantity, price, type of order, buy/sell, and the time of order entry is present and legible. This thoroughness minimizes the risk of errors, disputes, and regulatory scrutiny, demonstrating a commitment to compliance and customer protection. An incorrect approach involves relying solely on the trading desk to correct any errors on order tickets after execution. This fails to meet the NFA's requirement for accurate record keeping from the point of order entry. The regulatory framework emphasizes preventing errors at the source, not merely correcting them after the fact. This approach increases the risk of misinterpretation, unauthorized trades, and difficulties in reconstructing the trading process for audit or dispute resolution purposes. Another incorrect approach is to only retain order tickets that result in profitable trades. This is a clear violation of NFA record-keeping requirements, which mandate the retention of all order tickets, regardless of the outcome of the trade. The purpose of these records is to provide a complete audit trail of all trading activity, not just successful transactions. Failing to retain all tickets hinders regulatory oversight and makes it impossible to investigate customer complaints or market manipulation effectively. A further incorrect approach is to store order tickets in an unorganized and difficult-to-access manner, with no clear retention policy. This directly contravenes the NFA's requirement for records to be readily accessible. If regulators or auditors cannot quickly locate and review specific order tickets, it suggests a lack of proper control and compliance, potentially leading to penalties. Effective retention policies ensure that records are preserved for the required period and can be retrieved promptly when needed. Professionals should adopt a decision-making framework that prioritizes a thorough understanding of NFA rules and their practical application. This involves implementing standardized procedures for order ticket preparation, including mandatory pre-execution checks by qualified personnel. Furthermore, establishing a clear and consistent record-keeping and retention policy, supported by regular internal audits and training, is crucial. This proactive and systematic approach ensures ongoing compliance and mitigates potential risks. Question 6. The monitoring system demonstrates a pattern of highly leveraged, speculative trades in a client's futures account that deviates significantly from the client's stated investment profile and risk tolerance. As the branch manager in Illinois, what is the most appropriate initial course of action to uphold the just and equitable principles of trade under NFA Compliance Rule 2-4? Option A. File a suspicious activity report with the NFA based solely on the monitoring system's alert without any internal investigation. Option B. Initiate a confidential internal review of the trading activity involving compliance personnel to gather facts and assess potential violations before engaging with the client. Option C. Immediately contact the client to question their trading decisions and demand an explanation for the deviation from their stated profile. Option D. Disregard the trading activity as the client's independent decision, assuming no firm responsibility for their speculative choices. Correct answer is B. Initiate a confidential internal review of the trading activity involving compliance personnel to gather facts and assess potential violations before engaging with the client. Explanation: the monitoring system demonstrates a pattern of unusual trading activity in a client's account, raising concerns about potential market manipulation or other violations of just and equitable principles of trade under NFA Compliance Rule 2-4. This scenario is professionally challenging because it requires a branch manager to balance the need for prompt action to protect clients and the market with the importance of conducting a thorough and fair investigation before making accusations or taking punitive measures. The manager must exercise sound judgment, considering both the firm's obligations and the client's rights. The best approach involves initiating a confidential internal review of the trading activity. This review should be conducted by designated compliance personnel or senior management, independent of the account executive. The purpose is to gather objective facts, analyze the trading patterns in the context of market conditions and the client's stated investment objectives, and determine if there is a reasonable basis to suspect a violation of NFA Rule 2-4. If the review uncovers evidence suggesting a violation, the next steps would involve further investigation, potentially including communication with the client, and reporting to the NFA as required. This approach is correct because it adheres to the principles of due diligence, fairness, and regulatory compliance. It prioritizes a fact-based assessment before escalating the matter, thereby upholding the just and equitable principles of trade by avoiding premature judgment and ensuring a proper investigation. An incorrect approach would be to immediately confront the client and demand an explanation for the trading activity without first conducting an internal review. This is professionally unacceptable because it bypasses the firm's internal controls and investigative procedures. It could lead to an unfounded accusation, damaging the client relationship and potentially exposing the firm to liability if the trading activity is later found to be legitimate. Furthermore, it fails to gather sufficient evidence to support any potential regulatory action. Another incorrect approach would be to ignore the red flags identified by the monitoring system, assuming the client is acting independently and that the activity is not the firm's concern. This is a serious regulatory and ethical failure. NFA Compliance Rule 2-4 imposes a duty on FCMs and their associated persons to act in a manner that is just and equitable. This includes having systems in place to detect and prevent manipulative or fraudulent trading. Ignoring such signals abdicates the firm's responsibility to supervise its employees and protect its clients and the integrity of the market. A final incorrect approach would be to immediately report the activity to the NFA based solely on the monitoring system's alert, without any internal investigation or corroborating evidence. While prompt reporting is crucial when a violation is suspected, doing so prematurely without a preliminary assessment can lead to unnecessary regulatory scrutiny for the client and the firm, and may be seen as a failure to conduct proper due diligence. The firm has an obligation to investigate and form a reasonable belief of a violation before making a formal report, unless specific circumstances dictate otherwise. Professionals should employ a structured decision-making process when faced with such situations. This involves 1. Recognizing the alert or red flag. 2. Consulting internal policies and procedures for handling such alerts. 3. Initiating a confidential, fact-finding internal review. 4. Analyzing the gathered information against relevant regulations and ethical standards. 5. Determining the appropriate course of action based on the findings, which may include further investigation, client communication, or regulatory reporting. This systematic approach ensures fairness, compliance, and effective risk management. Question 7. Implementation of customer deposit procedures in a branch office of a futures commission merchant, FCM, in Illinois requires strict adherence to NFA regulations. If a customer in Illinois wishes to deposit a check for trading margin, what is the most appropriate and compliant course of action for the branch manager? Option A. Inform the customer that all checks for trading margin must be sent directly to the FCM's main office for processing and deposit. Option B. Accept the customer's check at the branch office and then forward it directly to the FCM's main office for deposit. Option C. Accept the customer's check at the branch office and deposit it into a separate, firm-controlled account at a local bank before forwarding it to the FCM's main office. Option D. Advise the customer to cancel the check and instead send the funds directly to the FCM's main office via a wire transfer. The correct answer is A. Inform the customer that all checks for trading margin must be sent directly to the FCM's main office for processing and deposit. Explanation. Scenario analysis. This scenario is professionally challenging because it involves a direct request from a customer that, if handled improperly, could lead to significant regulatory violations and damage to the firm's reputation. The core challenge lies in balancing customer service with strict adherence to NFA rules regarding the handling of customer funds. A branch manager must exercise careful judgment to ensure all deposit procedures are compliant, transparent, and protect the customer's assets. Correct approach analysis. The best professional practice involves immediately informing the customer that all funds must be remitted directly to the FCM's main office, as per NFA rules. This approach is correct because it directly aligns with CFTC Regulation 117 and NFA financial requirements, which mandate that customer funds be held by the Futures Commission Merchant, FCM itself, not by introducing brokers or their branch offices. This ensures segregation of customer funds and proper accounting. Ethically, it demonstrates integrity and a commitment to safeguarding client assets by following established, regulated procedures. Incorrect approach is analysis. Directly accepting the check and forwarding it to the FCM's main office, while seemingly efficient, is incorrect because it bypasses the established protocols for handling customer funds. This action could be construed as the branch office improperly taking possession of customer funds, even with the intention of forwarding them. It creates a risk of commingling or misplacement and deviates from the strict segregation requirements. Depositing the check into a separate, firm-controlled account at a local bank before forwarding it to the FCM's main office is also incorrect. This creates an unauthorized holding account, which is a direct violation of regulation requiring customer funds to be held by the FCM directly and segregated. It introduces unnecessary complexity and risk, potentially leading to confusion about the source and destination of funds. Advising the customer to send the funds directly to the FCM's main office via a wire transfer, while a valid method of remittance, is incomplete if the customer has already prepared a check. The immediate issue is the handling of the physical check. While a wire transfer is compliant, the initial request was for check handling, and the correct response must address that directly by stating the proper procedure for check deposits, which is to have them sent directly to the FCM. Professional reasoning. Professionals should always prioritize regulatory compliance when handling customer funds. Decision-making process should begin with identifying the specific regulations governing the transaction, in this case, NFA and CFTC rules on customer funds. Then, evaluate each potential action against these regulations. If a customer request deviates from established compliant procedures, the professional's duty is to educate the customer on the correct compliant method and refuse any action that could be interpreted as a violation, regardless of intent. Transparency and adherence to the FCM's established policies and procedures are paramount. Question 8. To address the challenge of a widespread power outage impacting its primary data center in Illinois, a Futures Commission Merchant, FCM, registered in the United States must decide on the most appropriate immediate course of action to ensure operational continuity and compliance with regulatory requirements. Option A. Rely on informal communication channels and manual workarounds to continue processing transactions while awaiting the restoration of power to the primary data center, without formally invoking the business continuity and disaster recovery plan. Option B. Immediately activate the firm's comprehensive business continuity and disaster recovery plan, initiating failover procedures to its secondary, geographically dispersed data center and prioritizing the restoration of critical trading and customer account management systems. Option C. Wait for direct instructions from the Commodity Futures Trading Commission, CFTC, or the National Futures Association, NFA, before taking any action to restore operations. Option D. Focus on restoring non-essential administrative functions and internal communication systems before attempting to recover critical trading platforms and customer account access. The correct answer is B. Immediately activate the firm's comprehensive business continuity and disaster recovery plan, initiating failover procedures to its secondary, geographically dispersed data center, and prioritizing the restoration of critical trading and customer account management systems. Explanation: the scenario presents a common challenge for futures commission merchants, FCM, registered in the United States, ensuring operational resilience in the face of unforeseen disruptions. The professional challenge lies in balancing the immediate need to resume critical business functions with the regulatory obligation to maintain robust business continuity and disaster recovery, BC/DR, plans that protect customer assets and market integrity. This requires careful judgment to select the most effective and compliant response. The best approach involves immediately activating the firm's pre-established business continuity and disaster recovery plan, specifically focusing on the components designed to address a widespread power outage affecting the primary data center. This plan should detail procedures for failing over to a secondary, geographically dispersed data center, ensuring that critical trading systems, customer account information, and communication channels are restored within defined recovery time objectives, RTO, and recovery point objectives, RPO. This approach is correct because it directly aligns with the requirements of the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA, regarding operational risk management and the maintenance of adequate systems and controls. Specifically, CFTC Regulation 1.10 and NFA Rule 2-36 mandate that FCMs have adequate systems and procedures in place to safeguard customer funds and maintain orderly operations, which inherently includes robust BC/DR capabilities. Activating the plan demonstrates proactive risk management and adherence to regulatory expectations for business resilience. An incorrect approach would be to solely rely on manual workarounds and informal communication channels to continue operations without formally invoking the BC/DR plan. While some level of manual processing might be necessary during an initial outage, failing to trigger the formal plan means the firm is not systematically executing its predefined recovery procedures. This could lead to delays in restoring full functionality, increased risk of data loss or corruption, and potential noncompliance with RTOs and RPOs. Furthermore, it bypasses the structured testing and validation inherent in a formal BC/DR plan, making it difficult to assure regulators of the firm's ability to recover effectively. Another incorrect approach would be to prioritize the restoration of non-essential services before critical trading and customer account management functions. Regulatory requirements emphasize the protection of customer assets and the ability to execute trades. Delaying the recovery of these core functions in favor of less critical operations would expose customer accounts to undue risk and could disrupt market activity, violating the spirit and letter of regulations designed to ensure market stability and customer protection. Finally, an incorrect approach would be to wait for explicit instructions from regulators before initiating recovery procedures. While communication with regulators is important, the responsibility for initiating BC/DR procedures rests with the FCM. Proactive activation of the plan is a fundamental aspect of operational resilience and demonstrates the firm's commitment to its own risk management framework, rather than a reactive stance dependent on external directives. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and customer protection. This involves understanding the firm's BC/DR plan thoroughly, including its triggers, procedures, and recovery objectives. In the event of a disruption, the immediate step should be to assess the impact against the plan's scope, and, if the disruption meets the criteria for activation, to formally initiate the plan. Continuous testing and updating of the BC/DR plan are also crucial to ensure its effectiveness and alignment with evolving regulatory expectations and technological advancements. Question 9. Examination of the data shows that a California-based introducing broker is considering implementing a new incentive compensation program for its associated persons. The firm wants to ensure its program is competitive to attract and retain talent, while strictly adhering to NFA and CFTC regulations. Which of the following approaches to structuring management and incentive fees for associated persons best aligns with regulatory requirements and ethical considerations for an introducing broker? Option A. Base incentive compensation primarily on the volume of trades executed by clients, irrespective of the profitability of those trades or the actual management and incentive fees charged. Option B. Create a tiered incentive structure where higher compensation rates are offered for introducing new clients, without direct consideration of the ongoing management and incentive fees generated from those clients over time. Option C. Offer discretionary bonuses to associated persons that are not directly linked to the firm's fee income or client account performance, but rather to subjective performance metrics or overall firm profitability, without clear allocation to specific client fee structures. Option D. Tie associated persons' incentive compensation directly to a transparent percentage of the management and incentive fees generated from the client accounts they service, ensuring full disclosure of all fee structures to clients. The correct answer is D. Tie associated persons' incentive compensation directly to a transparent percentage of the management and incentive fees generated from the client accounts they service, ensuring full disclosure of all fee structures to clients. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a branch manager in California to balance the firm's desire to attract and retain top talent with the strict regulatory requirements governing compensation structures for introducing brokers. The core tension lies in designing an incentive program that is both competitive and compliant with NFA rules and CFTC regulations, particularly concerning how fees are structured and disclosed to customers. Misinterpreting or misapplying these rules can lead to significant regulatory action, reputational damage, and financial penalties. Careful judgment is required to ensure that incentive compensation does not inadvertently create conflicts of interest or lead to misleading customer communications regarding fees. Correct approach analysis. The best professional practice involves structuring the incentive compensation program to be directly tied to the firm's revenue generated from client accounts, ensuring that the compensation is a transparent percentage of the management and incentive fees charged to clients. This approach aligns the interests of the introducing broker and its associated persons with the firm's overall profitability derived from legitimate client services. Crucially, all fee structures and the associated compensation arrangements must be clearly and accurately disclosed to clients in accordance with NFA Rule 2-9 and CFTC Regulation 1-17, which mandate fair dealing and accurate record keeping. This transparency ensures clients understand the costs associated with their trading activities and how the firm and its personnel are compensated. Incorrect approaches analysis. One incorrect approach involves basing incentive compensation on the volume of trades executed by clients, regardless of the profitability of those trades or the actual management and incentive fees charged. This is problematic because it can incentivize associated persons to encourage excessive trading, potentially leading to increased costs for clients without a corresponding benefit, and creating a conflict of interest where the firm's compensation is derived from activity rather than value provided. This directly contravenes the principles of fair dealing and acting in the best interest of the client, as required by NFA Rule 2-9. Another incorrect approach is to offer discretionary bonuses to associated persons that are not directly linked to the firm's fee income or client account performance, but rather to subjective performance metrics or the firm's overall profitability, without clear allocation to specific client fee structures. This lacks transparency and can obscure the true cost of services to the client. Furthermore, if these bonuses are not properly documented and disclosed as part of the compensation structure, they could be seen as an attempt to circumvent fee disclosure requirements, violating NFA Rule 2-23 regarding communications with the public and CFTC Regulation 1-31 concerning record keeping. A third incorrect approach is to create a tiered incentive structure where higher compensation rates are offered for introducing new clients, irrespective of the ongoing management and incentive fees generated from those clients. While client acquisition is important, an overemphasis on acquisition, without regard to the long-term revenue generated through management and incentive fees, can lead to a focus on quantity over quality of client relationships and services. This can also create a situation where the compensation structure is not directly reflective of the value provided to the client over time, potentially leading to misrepresentations about the firm's compensation model. Professional reasoning. When designing or evaluating incentive compensation programs for introducing brokers in California, a branch manager must prioritize transparency, fairness, and compliance with NFA and CFTC regulations. The primary consideration should always be the client's best interest. This involves ensuring that all fees charged to clients are clearly disclosed and that the compensation paid to associated persons is directly and demonstrably linked to those disclosed fees and the services provided. A robust internal compliance framework, including regular reviews of compensation structures and client disclosure, is essential to mitigate risks and maintain regulatory adherence. Professionals should ask, does this compensation structure incentivize actions that are in the client's best interest, and are all fees and compensation clearly disclosed? Question 10. Research into the handling of bunched orders by a futures commission merchant in Illinois indicates a need to assess the branch manager's responsibilities. A client's order for 500 bushels of corn was bunched with other client orders, and the total bunched order for 2,000 bushels was executed at $4.50 per bushel. Upon execution, it was determined that 1,800 bushels could be allocated at $4.50, with the remaining 200 bushels allocated at $4.52 due to market fluctuations. The client's original order represented 25% of the total bunched order. If the client's order is to be allocated fairly, what is the total dollar amount the client should be credited for their 500 bushel order? Option A. The client should be credited for 1,800 bushels at $4.50 and 200 bushels at $4.52, with their 500 bushel order allocated proportionally. This means 25% of the 1,800 bushels, 450 bushels, are allocated at $4.50, and 25% of the 200 bushels, 50 bushels, are allocated at $4.52. The total credit would be 450 bushels $4.50 bushel plus 50 bushels $4.52 bushel equals $2, 0.25 plus $226 equals $2, 251. Option B. The client should be credited for their entire 500 bushel order at the initial execution price of $4.50 per bushel, totaling $2, 250. The difference in price for the remaining 200 bushels is absorbed by the firm. Option C. The client should be credited for 500 bushels at the execution price of $4.50 per bushel, and any additional bushels that can be allocated at that price are credited to the client first, up to their order size. The remaining bushels are then allocated at the higher price. Option D. The client should be credited for 500 bushels at the average price of the entire bunched order execution. The average price is calculated as /frac 1,800 times $4.50 plus 200 times $4.52. 2,000 equals /frac 8,100 plus $904 2,000 equals /frac 9,004 2,000 equals $4 502 Therefore, the client's credit would be 500 bushels $4 502 bushel equals $2 251. The correct answer is A. The client should be credited for 1,800 bushels at $4.50 and 200 bushels at $4.52 with their 500 bushel order allocated proportionally. This means 25% of the 1,800 bushels, 450 bushels, are allocated at $4.50, and 25% of the 200 bushels, 50 bushels, are allocated at $4.52. The total credit would be 450 bushels $4.50 bushel plus 50 bushels $4.52 bushel equals $2, 0.25 plus $226 equals $2, 251. Explanation. This scenario presents a professional challenge because the branch manager must balance the operational efficiency of bunched orders with the strict regulatory requirements designed to protect customers and ensure fair execution. Mismanaging bunched orders can lead to significant financial losses for customers, regulatory sanctions, and damage to the firm's reputation. The core of the challenge lies in accurately allocating bunched orders in a way that is fair and equitable to all participating customers, especially when market prices fluctuate between the time the orders are aggregated and when they are executed. The correct approach involves meticulously documenting the bunched order, including the time of aggregation and the specific customer accounts involved. Upon execution, the total quantity should be allocated to individual customer accounts on a pro rata basis, reflecting their participation in the bunched order. Any resulting fractional shares should be handled in a manner that is clearly defined and consistently applied, typically by allocating them to the firm's proprietary account, and then selling or buying them at the execution price, with any profit or loss credited or debited to the respective customer accounts. This method ensures that each customer receives a fair share of the executed price, and that any discrepancies arising from fractional shares are managed transparently and equitably, aligning with NFA Rule 2-26 regarding the handling of customer orders and the principles of best execution. An incorrect approach would be to allocate the bunched order based on the order in which customer orders were received by the firm, regardless of the execution price. This fails to account for market movements that may have occurred between the aggregation of the bunched order and its execution, potentially disadvantaging customers whose orders were aggregated earlier but executed later at a less favorable price. This practice violates the principle of fair allocation and can be seen as an unfair or deceptive practice. Another incorrect approach is to allocate the bunched order by assigning the entire executed quantity the largest customer account first, and then distributing any remaining shares to smaller accounts. This method is inherently unfair as it prioritizes certain customers over others without a justifiable basis, leading to unequal treatment and potential financial harm to those who do not receive their full allocation at the execution price. This directly contravenes the spirit and letter of regulations requiring equitable treatment of all customers. A further incorrect approach involves allocating the bunched order based on the discretion of the branch manager, without a predefined, objective methodology. This introduces subjectivity and the potential for bias, making it impossible to demonstrate fair and consistent treatment of all customers. Such an approach lacks transparency and accountability, opening the firm to accusations of preferential treatment and regulatory scrutiny. The professional decision-making process for handling bunched orders should begin with a thorough understanding of NFA Rule 2-26 and the firm's internal policies. Before bunching any orders, the manager must ensure that all participating customers have agreed to this practice. Upon execution, the priority is to use a documented, objective, and consistently applied allocation methodology, such as pro rata distribution. Any exceptions or deviations from this methodology must be clearly justified and documented. Regular review and auditing of bunched order handling procedures are essential to ensure ongoing compliance and fairness. Question 11. Strategic planning requires a branch manager in Illinois to oversee the development and dissemination of promotional materials. Given the strict requirements of NFA Compliance Rule 2-29 concerning communications with the public, which of the following actions best demonstrates responsible oversight and adherence to regulatory standards? Option A. Authorize the release of promotional materials based on positive feedback received from clients in previous similar campaigns. Option B. Implement a rigorous internal review process where all draft promotional materials are submitted to the branch manager for explicit approval, ensuring they are fair, balanced, and contain all necessary disclosures before public release. Option C. Approve promotional materials based on their prior approval by the firm's general legal department, assuming all necessary regulatory checks have been performed. Option D. Delegate the responsibility of ensuring promotional materials comply with NFA rules entirely to the sales team, trusting their understanding of regulatory requirements. The correct answer is B. Implement a rigorous internal review process where all draft promotional materials are submitted to the branch manager for explicit approval, ensuring they are fair, balanced, and contain all necessary disclosures before public release. Explanation. This scenario presents a common ethical challenge for NFA branch managers in Illinois, requiring a delicate balance between promoting business growth and adhering strictly to NFA Compliance Rule 2-29 regarding communications with the public and promotional material. The challenge lies in the potential for even well-intentioned marketing efforts to inadvertently mislead or omit crucial information, thereby violating regulatory requirements. Careful judgment is paramount to ensure all communications are fair, balanced, and not misleading. The best professional approach involves proactively reviewing and approving all promotional materials to ensure they comply with NFA rules and accurately represent the firm's services and risks. This includes verifying that any claims made are substantiated, disclosures are clear and conspicuous, and the overall message is not deceptive. This approach directly addresses the core of NFA Compliance Rule 2-29 by placing responsibility on the branch manager to ensure that all public communications are compliant before they are disseminated. It prioritizes regulatory adherence and client protection, which are fundamental ethical obligations for NFA members. An approach that relies solely on the sales team to self-certify compliance is professionally unacceptable. This fails to acknowledge the supervisory responsibilities of the branch manager and creates a significant risk of non-compliance. NFA Compliance Rule 2-29 places a direct obligation on the branch manager to oversee and approve promotional materials, not to delegate this critical function without adequate oversight. Another professionally unacceptable approach is to approve materials based on their past approval by the firm's legal department without independent verification. A legal review is important. It does not absolve the branch manager of their responsibility to ensure current compliance with NFA rules, which may have evolved or have specific nuances not fully captured by a general legal review. The branch manager must understand and apply the specific requirements of NFA Compliance Rule 2-29 to the material in question. Finally, an approach that approves materials based on their general positive reception by clients is also professionally flawed. Client satisfaction is important, but it is not a substitute for regulatory compliance. Promotional materials can be popular while still being misleading or omitting necessary disclosures, thereby violating NFA Compliance Rule 2-29. The focus must remain on accuracy, fairness, and completeness as dictated by the regulations, not solely on client perception. Professionals should employ a decision-making framework that begins with a thorough understanding of the relevant regulations, specifically NFA Compliance Rule 2-29 in this context. This should be followed by a systematic review of any proposed communication, assessing it against each prong of the rule. When in doubt, seeking clarification from the firm's compliance department or legal counsel is essential. The ultimate goal is to ensure that all public communications are not only effective in promoting business, but are also fully compliant and ethically sound, protecting both the firm and its clients. Question 12. System analysis indicates that a branch manager in Illinois, overseeing a team of registered individuals, has noticed a recurring pattern of minor discrepancies in the daily performance logs submitted by several team members. These discrepancies, while individually small, collectively could paint a slightly less favorable picture of the branch's overall performance if aggregated and reported without context. The branch manager is under pressure from senior management to demonstrate consistent positive performance trends. What is the most appropriate course of action for the branch manager to take regarding these performance records? Option A. Immediately investigate the root cause of each discrepancy, document all findings and any corrective actions taken, and ensure all performance records are updated to accurately reflect the day's activities before submission. Option B. Instruct the team to focus on submitting logs that highlight positive outcomes and to downplay or omit details related to the minor discrepancies to present a more favorable overall performance narrative. Option C. Prioritize meeting the branch's performance targets above all else, and only address the discrepancies if they become significant enough to directly impact the achievement of those targets. Option D. Advise the team to continue submitting the logs as they are, with the expectation that the discrepancies will likely resolve themselves over time and are too minor to warrant immediate attention. The correct answer is A. Immediately investigate the root cause of each discrepancy, document all findings and any corrective actions taken, and ensure all performance records are updated to accurately reflect the day's activities before submission. Explanation. This scenario presents a professional challenge because it requires a branch manager to balance the firm's desire for strong performance with the ethical imperative to maintain accurate and complete records, as mandated by NFA regulations. The pressure to meet targets can create a temptation to overlook or downplay minor discrepancies, but the integrity of performance records is fundamental to regulatory compliance and client trust. Careful judgment is required to ensure that all performance-related data is captured and presented truthfully, without manipulation. The best approach involves a proactive and transparent method of addressing performance data. This includes promptly identifying any potential issues, thoroughly investigating their root cause, and documenting all findings and corrective actions taken. This approach aligns with NFA Rule 2-2, which requires members to maintain accurate books and records, and NFA Interpretive Notice 90-34, which emphasizes the importance of maintaining records that accurately reflect the business of the member. By addressing discrepancies openly and documenting the process, the branch manager demonstrates a commitment to regulatory compliance and ethical conduct, ensuring that performance records are a true reflection of the firm's activities. An approach that involves selectively reporting only positive performance metrics or omitting details about underperforming areas is ethically unsound and violates NFA record-keeping requirements. This constitutes a misrepresentation of performance and can mislead both internal stakeholders and potentially clients if such information were to be shared. Fails to provide a complete and accurate picture, which is a core tenet of regulatory compliance. Another unacceptable approach is to delay addressing performance issues or to hope they resolve themselves without intervention. This passive stance can lead to the accumulation of inaccurate data and can be interpreted as an attempt to conceal problems. Regulatory bodies expect prompt and diligent attention to record keeping, and inaction can be as detrimental as active misrepresentation. Finally, an approach that focuses solely on meeting targets without regard for the accuracy or completeness of the underlying performance records is fundamentally flawed. While performance is important, it must be achieved and documented in a manner that adheres to all applicable regulations and ethical standards. Prioritizing outcomes over the integrity of the data used to measure those outcomes creates significant compliance risks. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves understanding the specific record-keeping obligations under NFA rules, fostering a culture of transparency within the branch, and implementing robust internal controls to ensure data accuracy. When performance issues arise, the framework should guide the manager to investigate, document, and report findings truthfully and promptly, seeking guidance from compliance personnel when necessary. Question 13. Risk assessment procedures indicate that a large institutional client of your firm, operating in Illinois, is seeking to execute a substantial trade in a particular commodity futures contract based on information they claim to have received from a confidential source within a publicly traded company. This information, if true, would likely cause a significant price movement in the commodity. Your firm stands to earn substantial commissions from this trade. What is the most appropriate course of action? Option A. Execute the trade immediately for the client, assuming the client is acting independently and the firm is merely facilitating a transaction. Option B. Proceed with the trade after a brief internal discussion among senior management, rationalizing that the information's definitive insider status is uncertain and the commission revenue is significant. Option C. Immediately halt any discussion or action regarding the client's proposed trade and report the situation to the firm's compliance department for immediate review and guidance. Option D. Advise the client to delay their trade until after the public announcement of the information, while the firm internally researches the public availability of the information. The correct answer is C. Immediately halt any discussion or action regarding the client's proposed trade and report the situation to the firm's compliance department for immediate review and guidance. Explanation. This scenario presents a professional challenge because it pits a firm's potential revenue against its fiduciary duty to clients and the integrity of its trading practices. The branch manager must navigate a situation where a lucrative opportunity for the firm could be perceived as exploiting non-public information, creating a significant conflict of interest. Careful judgment is required to uphold regulatory standards and ethical obligations. The best professional approach involves immediately ceasing any further discussion or action related to the potential trade and reporting the situation to the compliance department. This approach is correct because it prioritizes regulatory compliance and ethical conduct above potential profit. Securities and Exchange Commission (SEC) and the National Futures Association (NFA) have strict rules against trading on material non-public information, MNPI. By immediately halting the discussion and reporting, the manager demonstrates adherence to the principles of fair dealing and market integrity, preventing any potential violation of Rule 2-23 of the NFA Rules of Fair Practice and Conduct, which prohibits manipulative or deceptive practices. This proactive step ensures that the firm does not engage in or appear to engage in insider trading, thereby protecting both the firm and its clients from legal and reputational damage. An incorrect approach would be to proceed with the trade after a brief internal discussion among senior staff, rationalizing that the information is not definitively insider, and the potential profit is too significant to ignore. This is ethically and regulatorily flawed because it disregards the spirit of regulations designed to prevent market manipulation and unfair advantages. The NFA's Interpretive Notice 96-10, regarding supervision and compliance, emphasizes the responsibility of managers to ensure that their firms and associated persons do not engage in fraudulent or manipulative activities. Proceeding with the trade without a thorough compliance review and a clear determination that no MNPI is involved would be a direct violation of this supervisory duty and could lead to severe penalties. Another incorrect approach would be to advise the client to delay their trade until after the public announcement, while the firm internally researches the information's public availability. This is problematic because it still involves the firm in a situation where they are privy to potentially sensitive information and are attempting to leverage it, even indirectly. While seemingly cautious, it creates a risk of appearing to tip the client or engage in preemptive trading strategies based on non-public information, which can still violate NFA rules and SEC regulations concerning market manipulation and insider trading. The core issue is the firm's knowledge of information that is not yet public and its subsequent actions or advice based on that knowledge. Finally, an incorrect approach would be to execute the trade immediately for the client, assuming the client is acting independently and the firm is merely facilitating a transaction. This is a critical failure in professional judgment and regulatory compliance. The firm and its associated persons have a duty to supervise their clients' activities and to ensure that their own actions do not facilitate illegal or unethical trading. The NFA's Rule 2-23 and related interpretations require firms to have systems in place to detect and prevent manipulative trading. By executing the trade without considering the source and nature of the client's information, the firm could be seen as complicit in a potential insider trading scheme, exposing itself to significant liability. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical considerations. This involves 1. Identifying potential conflicts of interest or regulatory red flags. 2. Immediately halting any action that could be construed as a violation. 3. Consulting with the firm's compliance department and legal counsel. 4. Documenting all communications and decisions. 5. Acting with transparency and adhering strictly to established rules and ethical guidelines, even if it means foregoing potential profits. Question 14. Compliance review shows that a branch manager in Ontario, Canada, who oversees a commodity pool, has been offered the opportunity by the pool's principal to purchase units in that same pool for their personal account, with the principal offering to facilitate the transaction. What is the most appropriate course of action for the branch manager to take to ensure compliance with Ontario Securities Commission regulations and NFA guidelines? Option A. Rationalize that since the principal is offering to facilitate the purchase, it indicates a favorable arrangement and no further action or disclosure is necessary beyond accepting the offer. Option B. Immediately disclose the personal investment opportunity to the principal and seek independent legal counsel to review the situation and advise on the proper course of action. Option C. Accept the principal's offer to facilitate the purchase of pool units for their personal account without further disclosure or consultation, assuming the principal's involvement ensures a fair transaction. Option D. Proceed with purchasing the pool units for their personal account and disclose the transaction to the principal only after the purchase has been completed. The correct answer is B. Immediately disclose the personal investment opportunity to the principal and seek independent legal counsel to review the situation and advise on the proper course of action. Explanation. This scenario presents a professional challenge because it involves a potential conflict of interest and a breach of fiduciary duty. A branch manager in Ontario, Canada, overseeing a commodity pool, must ensure that all transactions, especially those involving principals, are conducted with the utmost integrity and in compliance with the Ontario Securities Commission (OSC) regulations and National Futures Association (NFA) rules applicable to commodity pool operators. The core issue is whether the branch manager's personal investment in the pool, facilitated by the pool's principal, creates an undue influence or a situation where the principal's interests might be prioritized over those of other pool participants. Careful judgment is required to uphold fairness and transparency. The best professional approach involves immediately disclosing the personal investment to the principal and seeking independent legal counsel. This approach is correct because it proactively addresses the potential conflict of interest. By disclosing the investment, the branch manager demonstrates transparency and a commitment to ethical conduct. Seeking independent legal counsel ensures that the situation is reviewed from a neutral, expert perspective, guaranteeing that all actions taken are fully compliant with OSC regulations and NFA guidelines concerning related party transactions and conflicts of interest. This safeguards the interests of all pool participants and maintains the integrity of the commodity pool. An incorrect approach involves accepting the principal's offer to facilitate the purchase without any disclosure or seeking external advice. This is professionally unacceptable because it bypasses crucial conflict of interest protocols. It creates an appearance of impropriety and potentially violates OSC rules requiring disclosure and fair dealing with all investors. Furthermore, it fails to adhere to NFA requirements for robust internal controls and supervision, designed to prevent such conflicts from influencing investment decisions. Another incorrect approach involves proceeding with the investment, but only disclosing it to the principal after the purchase is complete. This is professionally unacceptable as it is reactive rather than proactive. While disclosure occurs, the timing is problematic. The decision to invest was made without the principal being fully aware of the potential conflict, and the subsequent disclosure does not rectify the initial lack of transparency or the potential for undue influence during the decision-making process. This falls short of the proactive ethical standards expected under OSC and NFA oversight. A further incorrect approach involves rationalizing that, since the principal is facilitating the purchase, it implies a favorable arrangement, and therefore no further action is needed. This is professionally unacceptable because it relies on assumption rather than verifiable compliance. The principal's facilitation does not negate the branch manager's fiduciary duty to all pool participants or the regulatory obligation to manage conflicts of interest transparently. This approach ignores the potential for the principal to leverage their position to benefit the branch manager, potentially at the expense of other investors, which is a direct violation of regulatory principles. The professional reasoning process for similar situations should involve a clear framework. 1. Identify potential conflicts of interest. 2. Prioritize transparency and disclosure to all relevant parties, including supervisors and legal counsel. 3. Seek independent advice to ensure compliance with all applicable regulations OSC, NFA. 4. Document all decisions and communications thoroughly. 5. Always act in the best interest of all clients and the integrity of the market. Question 15. Governance review demonstrates that a Registered Futures Commission merchant, FCM, in Illinois is considering appointing an individual with a history of significant regulatory sanctions from prior employment in the financial services sector to a principal position. The firm's compliance department is responsible for assessing this candidate's suitability. Which of the following approaches best reflects the required due diligence and regulatory expectations for such a critical appointment? Option A. Focus primarily on the candidate's strong business background and potential to generate revenue, while giving minimal consideration to past regulatory sanctions, assuming they are not directly relevant to the current principal responsibilities. Option B. Accept the candidate's assurances that they have learned from past mistakes and are now fully compliant, without independently verifying the details of their regulatory history or the specific actions taken to address past issues. Option C. Conduct a thorough investigation into the nature and severity of the candidate's past regulatory infractions, independently verify disciplinary records, interview the candidate extensively about their past conduct and remediation efforts, and document a comprehensive assessment of their fitness and integrity for the principal role. Option D. Rely on the candidate's self-reported disciplinary history, assuming that if the sanctions were not severe enough to prevent them from seeking employment in the industry, they are acceptable for a principal position. The correct answer is C. Conduct a thorough investigation into the nature and severity of the candidate's past regulatory infractions, independently verify disciplinary records, interview the candidate extensively about their past conduct and remediation efforts, and document a comprehensive assessment of their fitness and integrity for the principal role. Explanation: Governance review demonstrates that a registered Futures Commission merchant, FCM, in Illinois, is preparing to onboard a new principal who has a history of significant regulatory infractions in their previous roles within the financial services industry. The firm's compliance department is tasked with assessing the suitability of this individual to hold a principal position, which carries significant supervisory responsibilities under NFA rules. This scenario is professionally challenging because the firm must balance its business objectives of growth and talent acquisition with its paramount regulatory obligation to ensure that all principals are fit and proper. Failure to conduct a thorough due diligence process could expose the firm to significant regulatory penalties, reputational damage, and potential harm to customers. The best approach involves a comprehensive and proactive assessment of the candidate's past regulatory history, focusing on the nature and severity of the infractions, the disciplinary actions taken, and the candidate's demonstrated understanding and remediation of past failures. This includes obtaining and reviewing all relevant disciplinary records, conducting in-depth interviews with the candidate to understand their perspective and any mitigating factors, and assessing their current knowledge of and commitment to regulatory compliance. The firm should then document this assessment thoroughly, including a clear justification for why the candidate is deemed fit and proper, or conversely, why they are not. This aligns with NFA's emphasis on principals having the necessary experience, competence, and integrity to fulfill their supervisory duties and to comply with NFA rules and the Commodity Exchange Act. The firm must demonstrate to the NFA that it has exercised due diligence in its hiring process for principals. An approach that involves merely accepting the candidate's self-reported information without independent verification of their regulatory history is professionally unacceptable. This fails to meet the due diligence standards expected of an FCM and could be seen as a willful disregard for regulatory requirements. Relying solely on the candidate's assurances that they have learned from past mistakes, without independently confirming the details of those mistakes and the corrective actions taken, is insufficient. Another unacceptable approach would be to downplay or overlook past regulatory issues, assuming that because they occurred at a different firm or in a different capacity, they are not relevant to the current principal role. NFA rules require an assessment of a principal's overall fitness and integrity, and past disciplinary actions are highly relevant indicators. Ignoring or minimizing such history demonstrates a lack of commitment to robust compliance and a failure to uphold the integrity of the futures industry. Finally, an approach that focuses solely on the candidate's business acumen and potential revenue generation, while neglecting a thorough review of their regulatory background, is also professionally unsound. While business success is important, it cannot come at the expense of regulatory compliance and ethical conduct. The NFA's fitness and propriety standards are designed to protect the market and its participants, and a principal's history is a critical component of this assessment. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves a proactive and thorough due diligence process for all individuals in principal positions, a commitment to independent verification of information, and a clear understanding of the regulatory expectations for fitness and propriety. When evaluating candidates with past regulatory issues, the focus should be on understanding the nature of the issues, the individual's response and remediation, and their current commitment to compliance, rather than simply accepting assurances or dismissing past events. Question 16. Governance review demonstrates that a branch manager in Illinois is onboarding a new associate who has passed the Series 30 exam. Simultaneously, another associate is departing the firm, and their AP termination notice has not yet been filed. The new associate has applied for a temporary license and is eager to begin soliciting business immediately. What is the most appropriate course of action for the branch manager to ensure regulatory compliance? Option A. Allow the new associate to begin soliciting business under their temporary license while the registration process is pending, and defer filing the termination notice for the departing associate until the end of the week. Option B. Initiate the registration process for the new associate, verify their designated sponsor, and immediately file the AP termination notice for the departing associate. Option C. Focus solely on ensuring the new associate's temporary license is active and permit them to solicit business, while waiting for the departing associate's termination notice to be processed by the NFA. Option D. Prioritize the new associate's temporary license and allow them to solicit business, assuming their sponsor will be verified later, and address the termination notice once the new associate is fully registered. The correct answer is B. Initiate the registration process for the new associate, verify their designated sponsor, and immediately file the AP termination notice for the departing associate. Explanation. Scenario analysis. This scenario presents a common challenge for a branch manager in Illinois, requiring a nuanced understanding of NFA registration requirements and sponsor verification obligations. Core difficulty lies in balancing the need to onboard new talent quickly with the absolute necessity of complying with NFA Bylaw 1101 and related rules concerning registration and sponsorship. Failure to properly verify sponsorship and ensure timely registration can expose the firm to regulatory scrutiny, fines, and reputational damage, while also potentially leaving the firm liable for the actions of unregistered individuals. The manager must navigate the complexities of temporary licenses and termination notices to maintain compliance. Correct approach analysis. The best professional practice involves immediately initiating the registration process for the new associate, ensuring their sponsor is verified, and that the firm has submitted the necessary AP termination notice for the departing individual. This approach directly addresses the regulatory requirements of NFA Bylaw 1101, which mandates that APs must be registered with the NFA. By verifying the sponsor, the firm fulfills its due diligence obligation to ensure the new AP is properly supervised. Promptly filing the termination notice for the departing AP is also crucial to avoid any potential liabilities associated with an individual who is no longer associated with the firm. This proactive and compliant approach minimizes regulatory risk and ensures operational integrity. Incorrect approaches analysis. One incorrect approach involves allowing the new associate to begin soliciting business before their registration is complete, relying solely on the temporary license. While temporary licenses offer a brief window, they are not a substitute for full registration, and soliciting business without proper registration and verified sponsorship is a violation of NFA rules. Another incorrect approach is to delay filing the AP termination notice for the departing individual, assuming it will be handled later. This creates a gap in the firm's compliance record and could lead to confusion or liability if the departing individual's actions are misattributed to the firm. Finally, failing to verify the sponsor's credentials and ensuring they are in good standing before allowing the new associate to operate under their supervision is a significant breach of due diligence and NFA requirements. Professional reasoning. Professionals in this situation should adopt a systematic approach. First, identify all individuals requiring registration or whose registration status has changed. Second, consult the relevant NFA regulations, particularly Bylaw 1101 and any applicable state regulations for Illinois. Third, prioritize the completion of all required documentation and verification steps before allowing any individual to engage in activities requiring registration. Fourth, maintain meticulous records of all registration filings, sponsor verifications, and termination notices. This structured process ensures that all regulatory obligations are met, minimizing risk and upholding ethical standards. Question 17. Governance review demonstrates that the branch manager of a Futures Commission merchant, FCM, located in Chicago, Illinois, has been diligently overseeing trading activities and client communications. However, the review has also highlighted potential gaps in the systematic maintenance and accessibility of certain client-related documentation, including trade blotters, customer account statements, and correspondence logs. Branch manager has relied heavily on the firm's central compliance department to ensure all record-keeping obligations under NFA rules are met. Which of the following approaches best addresses the identified record-keeping concerns in compliance with NFA Rule 2-10? Option A. Delegate all record-keeping responsibilities to junior staff members without establishing a formal verification process or regular oversight from the branch manager. Option B. Continue to rely on the firm's central compliance department to manage all record-keeping requirements, assuming their oversight is sufficient for the branch's specific operations. Option C. Prioritize client-facing activities and trading execution, with the understanding that record-keeping tasks can be completed at a later, less busy time. Option D. Implement a detailed internal audit schedule for the branch's books and records. Conduct regular training sessions for all branch staff on NFA record-keeping requirements, and establish clear protocols for timely record creation and retrieval, ensuring the branch manager actively oversees adherence to these protocols. The correct answer is D. Implement a detailed internal audit schedule for the branch's books and records. Conduct regular training sessions for all branch staff on NFA record-keeping requirements, and establish clear protocols for timely record creation and retrieval, ensuring the branch manager actively oversees adherence to these protocols. Explanation. This scenario presents a common challenge for branch managers, balancing operational efficiency with stringent regulatory record-keeping requirements. The core difficulty lies in ensuring that all necessary documentation is maintained accurately and accessible, even when dealing with the day-to-day demands of client interactions and trading activities. A failure in this area can lead to significant regulatory penalties and reputational damage. The best professional practice involves a proactive and systematic approach to record keeping. This includes establishing clear internal policies and procedures that align with NFA Rule 2-10, which mandates the maintenance of books and records. Specifically, this approach emphasizes regular audits and training for staff to ensure compliance. By implementing a robust system of checks and balances, the branch manager can identify and rectify any deficiencies promptly, thereby safeguarding the firm and its clients. This aligns with the ethical obligation to conduct business with integrity and in accordance with all applicable regulations. An incorrect approach involves relying solely on the firm's general compliance department without active oversight at the branch level. While the compliance department provides guidance, the branch manager is ultimately responsible for the day-to-day adherence to record-keeping rules within their specific branch. This passive approach risks overlooking unique branch-specific issues or staff oversights that could lead to non-compliance. Another incorrect approach is to prioritize client-facing activities over record-keeping, assuming that records will be updated later. This creates a significant risk of incomplete or inaccurate records, as later often becomes never in a busy trading environment. NFA rules require records to be maintained in a timely manner, and delays can be interpreted as a failure to comply. Finally, an approach that involves delegating record-keeping responsibilities without adequate supervision or verification is also professionally unacceptable. While delegation is necessary, the ultimate accountability for maintaining accurate and complete records rests with the branch manager. Without proper oversight, the risk of errors or omissions increases substantially, potentially violating NFA Rule 2-10. Professionals should approach record-keeping by first understanding the specific requirements of NFA Rule 2-10 and any relevant interpretive guidance. They should then develop and implement clear, actionable procedures for their branch, ensuring all staff are trained and understand their roles. Regular internal reviews and audits, coupled with a commitment to timely record maintenance, are crucial for maintaining compliance and fostering an ethical business environment. Question 18. Quality control measures reveal that an individual employed by a Futures Commission merchant, FCM, in Illinois has been tasked with overseeing the daily operations of a satellite office and directly supervising several registered associated persons who handle customer accounts. This individual is not currently registered with the NFA in any capacity. Which of the following actions represents the most appropriate and compliant response for this individual and the FCM? Option A. The individual can continue to perform these supervisory duties, while the FCM initiates the process of registering the individual as a branch manager. Option B. The individual can continue to perform these supervisory duties as long as they are not making final trading decisions for clients. Option C. The individual can continue to perform these supervisory duties as long as the FCM has a general compliance officer overseeing the branch's activities. Option D. The individual must immediately cease all supervisory activities and apply for registration as an NFA branch manager before resuming any oversight responsibilities. The correct answer is D. The individual must immediately cease all supervisory activities and apply for registration as an NFA branch manager before resuming any oversight responsibilities. Explanation. Scenario analysis. This scenario presents a common challenge for individuals seeking to operate within the futures industry in Illinois. The core difficulty lies in understanding and adhering to the precise registration requirements mandated by the National Futures Association, NFA, and the Commodity Futures Trading Commission, CFTC, for individuals acting in a managerial capacity. Misinterpreting these requirements can lead to operating without proper authorization, which carries significant regulatory consequences. The need for careful judgment arises from the distinction between performing general supervisory duties and those that trigger a specific registration requirement as a branch manager. Correct approach analysis. The correct approach involves recognizing that the individual's role, as described, involves direct supervision of registered individuals and the oversight of daily operations at a branch location. This level of responsibility necessitates registration as an NFA branch manager. Specifically, NFA Rule 2-7(b) and CFTC Regulation 1.3(y) define a branch manager as an individual who supervises or has the authority to supervise other associated persons at a branch office. The individual's activities of overseeing daily operations and supervising registered associates directly align with this definition. Therefore, proactively seeking and obtaining the required NFA branch manager registration before commencing these duties is the only compliant course of action. This ensures adherence to regulatory oversight and maintains the integrity of the futures market. Incorrect approach is analysis. One incorrect approach is to assume that simply being an employee of a registered firm and having some oversight responsibilities is sufficient without formal registration. This fails to acknowledge the specific definition of a branch manager under NFA and CFTC rules, which is triggered by the nature and scope of supervision, not just general employment status. Operating without this specific registration is a violation of NFA Membership Rule 2-7(b) and CFTC Regulation 1.3(y). Another incorrect approach is to believe that only individuals with ultimate decision-making authority for the entire firm need to register as branch managers. This misunderstands the tiered nature of supervision and registration requirements. The NFA and CFTC regulations are designed to ensure that all levels of supervision, including at branch locations, are conducted by individuals who have met specific fitness and competency standards through registration. A further incorrect approach is to delay registration until a regulatory inquiry or audit occurs. This demonstrates a lack of proactive compliance and a disregard for the proactive nature of registration requirements. Operating in a capacity that requires registration without having obtained it beforehand is a direct violation, regardless of whether it has been discovered by regulators. Professional reasoning. Professionals in the futures industry must adopt a proactive and diligent approach to understanding and complying with registration requirements. This involves thoroughly reviewing NFA and CFTC regulations, particularly those pertaining to managerial and supervisory roles. When in doubt about whether a specific role triggers a registration requirement, the best practice is to err on the side of caution and consult with the NFA or legal counsel specializing in futures regulation. A robust internal compliance program should also guide employees on these matters, ensuring that individuals understand their obligations before assuming new responsibilities. Question: Quality control measures reveal that an individual employed by a Futures Commission merchant, FCM, in Illinois has been tasked with overseeing the daily operations of a satellite office and directly supervising several registered associated persons who handle customer accounts. This individual is not currently registered with the NFA in any capacity. Which of the following actions represents the most appropriate and compliant response for this individual and the FCM? Options: A. The individual must immediately cease all supervisory activities and apply for registration as an NFA branch manager before resuming any oversight responsibilities. B. The individual can continue to perform these supervisory duties while the FCM initiates the process of registering the individual as a branch manager. C. The individual can continue to perform these supervisory duties as long as they are not making final trading decisions for clients. D. The individual can continue to perform these supervisory duties as long as the FCM has a general compliance officer overseeing the branch's activities. Question 19. Governance review demonstrates that a client, a large-scale corn producer in Iowa, has entered into a significant number of corn futures contracts on the CME. The client states these contracts are for hedging purposes to protect against falling corn prices. The client's primary business involves growing and selling corn. The branch manager is tasked with verifying if these futures contracts qualify as bona fide hedging transactions under NFA and CFTC regulations. The client's total expected harvest for the upcoming season is 500,000 bushels. The client has sold 400,000 bushels of corn futures contracts for delivery in December, with the current spot price of corn at $4.50 per bushel and the December futures price at $4.30 per bushel. The client also holds a long position in 100,000 bushels of corn futures contracts for delivery in March, with the March futures price at $4.20 per bushel. The client's rationale for the March long position is that they anticipate needing to purchase corn for animal feed in the spring, and they want to lock in a favorable price. Which of the following approaches best represents the branch manager's responsibility in determining if these futures transactions constitute bona fide hedging? Option A. The branch manager should analyze the client's business operation to confirm that the futures contracts are intended to offset specific price risks associated with the production and sale of their corn harvest, and to offset the anticipated purchase of corn for animal feed, ensuring the size and timing of the futures positions are reasonably related to these exposures. Option B. The branch manager should focus on the mathematical correlation between the futures prices and the spot price, and calculate the potential profit or loss on the futures positions to determine if they are speculative or hedging. Option C. The branch manager should primarily consider the total number of bushels represented by the futures contracts, 500,000 bushels, and compare it to the client's expected harvest, 500,000 bushels, to determine if the positions are appropriately sized for hedging. Option D. The branch manager should accept the client's assertion that the transactions are for hedging purposes, as the client is a producer and consumer of corn, and the futures prices are lower than the current spot price, indicating a potential for price decline. The correct answer is A. The branch manager should analyze the client's business operation to confirm that the futures contracts are intended to offset specific price risks associated with the production and sale of their corn harvest, and to offset the anticipated purchase of corn for animal feed, ensuring the size and timing of the futures positions are reasonably related to these exposures. Explanation. Scenario analysis. This scenario presents a common challenge for branch managers in the U.S., specifically concerning the NFA's, National Futures Association, regulations under the Commodity Futures Trading Commission, CFTC, regarding bona fide hedging. The core difficulty lies in distinguishing between speculative positions and those genuinely intended to offset existing risks in a business operation. Mischaracterizing a position can lead to significant regulatory violations, fines, and reputational damage. The manager must apply a rigorous analytical framework to assess the intent and economic substance of the transaction. Correct approach analysis. The best professional practice involves a thorough review of the client's underlying business operations and the specific characteristics of the futures contract. This approach correctly identifies that a bona fide hedge requires a direct and substantial relationship between the futures position and the risk being hedged. The manager must verify that the futures contract is used to reduce the risk of price fluctuations in a commodity or asset that the client produces, consumes, or handles in their normal course of business. This aligns with CFTC Regulation 1.3(z)(1), which defines hedging as the purchase or sale of any commodity or product thereof, or any physically or financially settled futures contract or exchange-traded option that is intended to offset price risk. The manager's duty is to ensure the transaction meets this definition, not merely to accept the client's assertion. Incorrect approaches analysis. One incorrect approach involves accepting the client's statement that the transaction is a hedge without independent verification. This fails to meet the branch manager's supervisory responsibility under NFA Rule 2-36, which mandates diligent supervision and adherence to NFA interpretive notices. The manager is not absolved of responsibility by the client's declaration. They must actively ensure compliance. Another incorrect approach is to focus solely on the mathematical correlation between the futures price and the client's underlying asset price, without considering the client's business operations. While correlation is a factor, it is not the sole determinant of a bona fide hedge. The CFTC definition emphasizes the intent to offset price risk in a business context. A highly correlated position that does not serve to reduce a specific business risk is likely speculative. A third incorrect approach is to consider the size of the futures position relative to the client's physical inventory in isolation. While position size is relevant, it must be evaluated in conjunction with the nature of the business and the specific risks being managed. A position that is disproportionately large or small relative to the underlying business exposure, without a clear rationale for risk management, may indicate speculation rather than hedging. Professional reasoning. Branch managers must adopt a proactive and investigative stance. When a client claims a transaction is a bona fide hedge, the manager should initiate a process that includes 1. Understanding the client's business. What commodities or assets do they produce, consume, or handle? What are their primary price risks? 2. Analyzing the futures contract. What commodity or asset does it relate to? What is its expiration date? 3. Assessing the relationship. How does the futures contract directly offset a specific price risk in the client's business operations? Is the size of the futures position reasonably related to the exposure? 4. Documenting the rationale. Maintain clear records of the client's business, the risk being hedged, and the justification for classifying the transaction as a bona fide hedge. This systematic approach ensures compliance with regulatory definitions and upholds the integrity of the firm's operations.